Welcome, everyone. This is the DeFi panel to start. I'm Alex Chima. I'll be moderating the panel. I'm a professional DGen, known in Oxford as the DeFi guy. We have a great panel here. I want this to be the best panel you've ever been to on DeFi. If you're new to blockchain, because I know there's a lot of students around, I hope you get a lot from this. We'll cover three main topics. So the regulatory landscape, DeFi and TradFi convergence, and scalability in DeFi. So we're going to get a lot of insights in these 45 minutes. But I'm going to need your help. So please, while you're listening to the panelists, think of questions. Because we'll have time at the end for Q&A. So how many of you here are bullish on DeFi? Can you make some noise if you're bullish on DeFi? Great. Like, one of the reasons I personally became very bullish on DeFi originally was the kind of open and programmable nature of it. So it's very easy for anyone, really, to contribute to the DeFi ecosystem. And there's this kind of open ecosystem where anyone can innovate. And this kind of leads to very rapid innovation. So let me introduce the panel. So starting on the end, we have Masa Kikuchi. So Masa is the founder and CEO of Secured Finance, as well as the former head of derivative structuring at HSBC. He holds a position as a member of Trusted Web at the Cabinet Office in the Japanese government. He also has a background in computer science from Harvard University. Next up, we have Michael Bentley. So Michael is the founder and CEO of Euler Labs. He actually did his PhD here at Oxford. So I'm excited to welcome you back to Oxford, Michael.
Thank you.
Next up, we have Irene Wu. Irene Wu is the head of strategy at Layer Zero. She was previously an investor at Insight Partners. And she also has a background in computer science from Harvard University. And finally, last but not least, we have Maximilian Schneider. He is the founder of Mango Markets. He has over 10 years of experience working for DAX companies and unicorn startups. So really excited to have this awesome panel, and let's get straight into it. So as DeFi kind of evolves rapidly, we're seeing the regulatory landscape also evolving quite a bit. To set the context, could each of you share your insights on the current regulatory landscape for DeFi? And how do you see the regulatory landscape changing over the next few months?
Yeah, good question. It's kind of a tricky one to answer because there's a lot going on right now, as I'm sure you've seen in some parts of the world, which appear to be taking maybe more of a hostile stance towards innovation in Web3. But what I can say is that I think in the UK and in Europe, there are more positive signs that regulation's coming. And I think this is going to be massively welcomed by the industry at large, because today, DeFi largely operates in an unregulated environment. The rules aren't necessarily clear in each jurisdiction. So yeah, I think we're really looking forward to getting some clarity there. Ultimately, with a new technology, there are going to be lots of trade-offs, some good things about the technology, some bad things. And in some cases, the good things about DeFi actually are kind of inbuilt inside the technology are some of the kind of benefits that try to get enforced through regulation in traditional finance, but they just kind of come out of the box in DeFi. And so I think a lot of regulators are really starting to acknowledge that there are real positive trade-offs with DeFi, and what we need to figure out more broadly is how to sort of soften some of the trickier elements that DeFi brings as well. But in the UK, there are positive signs that the government and government agencies are working proactively to push innovation forward in the industry. I think they'll probably take a focus on stablecoins first, actually, and stablecoins are a huge part of DeFi, so that's important. And then I think we'll start to see more discussion about DAOs and decentralized finance, open finance in probably within the next 6 months to a year. But I don't think we're going to see anything change super quickly. It's really important that we get this stuff right. We don't want to rush and make a mistake because there's such huge opportunity for this technology.
I think the granular definitions that were introduced through some of the recent filings in the United States are at least a great step forward in seeing that American regulators are taking the time to inform themselves around the technology. So I was pleasantly surprised by that. However, as Michael said, these processes can take, upwards of 2+ years. And as developers and founders, it's important that you actually read the documents and stay informed, but not be taken up in the highs and lows of each day. We see different headlines every day. And as a builder, this is a really exceptional time just to hire and focus on building great product. And there are some tactical things you can employ to set up your project for more success and defensibility regardless of the regulatory environment. And so I think we're super grateful at Layer Zero Labs to have a really thoughtful general counsel, for example, and guidelines in place around how we're interacting with our community so that we're always prioritizing customer safety and also exploring what is out there from the global stage. So I think in this environment, nation states like Hong Kong, for example, are taking advantage of the decisions the United States are making and creating a more friendly environment for crypto. And we're starting to see venture funds relocate or open up offices elsewhere. And that just presents more opportunity for where you can draw talent from and also where you can set up your own devco and foundations. So essentially the TLDR on my side is if you're a builder or a founder, you should be staying informed, but I would advise you not to let the day-to-day headlines pull you in either direction. Stay firm with your conviction and keep building.
Yeah, I think that's actually like really good advice. There's like a serious productivity drop in the whole scene every time legal matters get discussed like on a big scale. I think what we saw like the last 2 weeks, the Coinbase and Binance thing is definitely putting a chilling environment on. It's of course the way it happens over there is there's a lot of allegations in those documents, right? Hundreds of pages long. You cannot assume that everything will be successful, right? And in the end, it's like to the judge to decide. That's exactly like the difference also in like the legal system, right? Over there, you have basically largely precedent-based legal work, while in the European Union, we have like we think about laws, and the laws is what matter, not necessarily the precedent, right? The spirit of the law, the original idea, etc. And so the way law is made on both sides of the pond is very, very different. And for me, it took some time to also like realize, okay, this is how the Americans are solving their issues, and this is their process, how they want to do it. But of course, it's very threatening for teams who are based in the US, who are wondering, okay, if there's one bad decision in court, then for a while, until that gets challenged and like drawn through higher courts, right? It might be impossible to operate as a business in the United States, right? So it's a very, I think, difficult situation, especially as most of the money, right, if you think about capital markets, comes from the United States. So the thing that basically fueled the crypto boom in the last years was the ease of access for American capital into crypto. And right now, these connections are all being severed off, right? We saw this with Silvergate, Silicon Valley Bank, etc. When that whole thing started, it immediately became nearly impossible to transfer between crypto and the fiat banking system on a large scale for institutional parties over there. And that's, I think that's, when you hear then, hey, why is there no alternative? Well, we're afraid the regulator's gonna come after us. We don't really know how we can do it. We have some like directions not to open bank accounts for crypto companies. So that's of course like something where you realize, okay, there's some force against the idea, right, fundamentally. And it's very hard to see that, right? And it's probably gonna change in a year, hopefully, right? That's kind of the timeline everyone is looking at. It feels like it's the last rush on the current government's push to change things up a bit. And then we'll see what the next president is going to decide, right? How regulation over there is going to look like.
Can I get the mic?
Hello.
Hello, hello. Okay. So you mentioned test. You mentioned capital markets. So right now, DeFi is kind of primarily made up of money markets, whereas TradFi is, most of the volume there is actually in capital markets. So how do you kind of see DeFi evolving, and how do you see the convergence of TradFi and DeFi coming about?
Hello. Okay, so we Secured Finance is building capital market, and what's really important right now is to bridge the gap between TradFi and DeFi by building a yield curve. And how we build yield curve is basically having time series loans, let's say 3 months, 1 year, 2 year. This fixed term loans is what we are building right now. Once we have those fixed term loan, we can link those dots to build a yield curve, and that's the initial step. That's really important first step. Right now, most DeFi are building a pool to support the liquidity, which is a great way. But actually, the pool is also depending on the external order book to correct the price. So we really need a kind of order book system, like a price oracle, to build the long-dated market. So that's really important, and it has been tried many ways, but it's really difficult to have enough liquidity for the long-dated market. But thanks to the token power, right? We have a token idea, and token is super powerful to incentivize not only traders, but also all the contributors to the ecosystem. That's how we can bring more liquidity to the market. And that's our basic approach to build the market, capital market.
Yeah, so how is TradFi and DeFi converging? I think there's a couple of areas that I see probably quite big growth in the next year. One extra thing that's been having a chilling effect on DeFi, of course, is the rise in global interest rates. And of course, if you can get 5% yield from treasuries, it's much more attractive to park capital in treasuries than it is to have capital sloshing around the riskier DeFi ecosystem. But increasingly, we do see firms that are creating the piping between DeFi and TradFi. So I think you see a lot more tokenization of treasuries and bonds. And this is quite important because it does enable essentially treasury yield to then flow it back into DeFi. Essentially what a lot of people do is they will mint a treasury token. They'll deposit that as collateral in some kind of lending market, borrow USDC, thereby driving up rates on USDC, take that USDC, repurchase the treasury, and sort of loop that transaction round several times and leverage the yield that they can gain. And through this, it of course brings increased interest rates back into DeFi. And so slowly but surely, we're seeing those pipelines, grow, and I think that's going to be a big growth sector for DeFi in the coming years, regulation permitting, of course. But again, there's a variety of jurisdictions in which these things can be created. It's maybe not going to be great in the US for some time, but I think elsewhere in Europe, we're actually seeing really proactive measures to encourage this kind of experimentation. So that's my take.
At Layer 0, if some of you in the audience aren't familiar, we've built a protocol called Layer 0, and it is the leading omni-chain interoperability protocol and enables communication between smart contracts on different chains. And so that can include permissioned or private chains and also public ones. And this is relevant because for most TradFi institutions, their interest in blockchain persists regardless of this regulatory environment. And I've seen this firsthand. But many of them are spinning up their own permission chains or are leveraging supernets or subnets. In particular, I'm thinking about Avalanche's Evergreen Subnets initiative, which allows institutions to partake in an EVM-compatible app chain, essentially, that allows for KYC and geofencing and like particular features that are important requirements for traditional institutions. But then the interoperability or the seamless communication between all of these chains is incredibly important. And so that's what Layer 0 enables. And what is critical to actually ensure TradFi's consistent participation is ultimately security in my eyes. With a lot of the existing protocols, I mean, we continue to see hacks and exploits largely due to smart contract upgrades or just buggy code every day, and institutions want to be able to own part of their security. And so the way that we implement this at Layer 0 is our protocol since day one was designed to be enterprise grade by allowing applications, whether it be a group of dropouts from Oxford building a DeFi protocol or JP Morgan, to run one component of their off-chain infrastructure so that they can have veto power over their own security, but not unilateral control. So it still remains decentralized. And this interest for, again, like I said, permission to public chain communication remains really high. So I'm quite hopeful about that. And I think we'll be seeing, though quite quietly over the next 6 months, a lot of like first transactions of this kind coming from the top 5 banks from around the world.
Yeah, I'm personally not so involved with this sector, but what I think is interesting what you said, right? These markets really function on a different principle, right? Like a money market means there's an actual asset, right? Everything in DeFi is spot, instant custody transfer. We don't really think about, oh, I owe you this thing, right? I have a credit line with you. These things don't really exist. What really exists is assets, custody by the individual participants, and peer-to-peer exchanged, or maybe collateral used, right? But it's always over-collateralized in most cases. That's what makes it safe, right? These were the first protocols that people built, that people trust in, and that are kind of in the spirit of what you can build with these distributed ledger technologies for now. And I think there's there's clearly like some inferiority compared to what you have in traditional finance, where you can go and say, well, how about, right, you look at my company, you look at my business, I want to raise a few $1 billion, just send me the money, we're going to pay you back in 10 years, right? This is not something you can do in DeFi, and I would actually not advise to do that. It's a little bit too risky, right? So there's a question, what do we do with this kind of concept, right? And you were talking about it, right? I think the one way to do it is to create the interface back to that market, saying, okay, well, we can offer this kind of deal to the old world, right? We can replicate the old world deal in the old world, but then take that capital and bring it into DeFi, bring it into the community and build more systems and use these systems that are built here. And then what you were mentioning is exactly the other way around, right? We're saying, well, we have these debt instruments. They're very powerful, right? Like they're very safe, like US treasuries, they're very attractive. So how can we bring those over? And it's basically the two parties start to dance with each other, right, without really changing the way they operate. And in the first step, right, because people are looking for a quick win, people are looking for something that's attractive to users, right? Treasury yield is extremely attractive right now. So how can we bring that on chain, right? Because those people need it. And I think over the time, as financial markets always have a very hot asset, right? I think the last year's crypto was that to some extent. Now it's treasury yields, right? Let's wait a few years. I think we'll see more types of assets that are relevant. A lot of people got very excited about real estate. I think when you talk to people who are really, really serious about NFTs, they believe they need to bring real estate in NFT form on chain. And I think that's quite crazy, but it's also very interesting if we can have the same level of guarantee, right? Because when you really think about it, a USDC or USDT, it's just a token that can be backed by nothing, in theory, right? But we created these systems, we created these companies that are trustworthy enough that we believe that this is really worth $1 at most points in time, maybe some weekends less than other weekends. Or I think last week there was some doubt again about it, but it's like most of the time we're pretty sure. And the longer it exists, right, we become familiar with it, and we start to think, hey, maybe we can have something less easy to understand, easy to audit than the US dollar on chain, right? And I think that's where we're probably going to see more movement. And there's a lot of smart people looking on, like, right, how can we get shares, ETFs, different derivatives bridged on chain. Yeah, and I'm quite interested in that, actually. I think it creates a real possibility for people to transact peer-to-peer without an intermediary, right? Directly with someone else in a completely trustless way, across borders, right, across nations, continents. You could technically be on the moon and sign your transaction, right? It's like, there's no limits there.
So I want to touch on a point you just mentioned about bringing TradFi instruments to DeFi, so shares, ETFs, that kind of stuff. I'm curious to get your thoughts on the kind of the opposite of bringing DeFi to TradFi. Max, you kind of started with mentioning the SEC case and how there's quite a chilling environment right now. How do you see TradFi getting involved in DeFi? What does the environment look like right now, and what needs to be done to get that kind of institutional adoption?
So what I see in Germany right now, the banks are really hot on just custody, right? Like that's a traditional part of the banking business, right? They take care of people's assets, either in a safe or on a cold wallet in this case. So that's seems like a very safe part of their product offering they can extend. There's a bunch of German banks who are saying, hey, we want to offer people custody of Bitcoin, we want to offer custody of ERC20 tokens. And I mean, it's clearly a reaction to what we saw with certain centralized exchanges in the last years, that people had their assets there hoping it was safe, also liking the comfort of not having to self-custody, right? And so this is the point, I think, where a traditional, fully audited, fully regulated institution is very happy that there is some regulatory clarity, at least in Germany, what it means to be a custodian, right? And then they can sit down and figure these things out. I think that's the way it goes, where we decide over, I would say, 5 or 6 years in the real world, right, through experimentation, what are the actual dangers? What are the problems? What do we need to prevent? What cannot happen again? What do people need to be able to not think about, right? I mean, to some extent, people start to think about the balance sheets of the biggest banks in the world, but I mean, the idea is that they don't have to think about that, right? Like, that's the idea of a healthy financial system, is you don't need to check everything in detail. So that's, I think, where regulation can help the most, because it can say, well, if you want to offer this kind of product, or you want to run this kind of service, or you want to deploy this kind of smart contract, right? God forbid, that would be really nice if they would finally write something about it. Then it would be interesting to know, do we need to have a multi-sig? Do we need to make it immutable? What's the safe way to do it? What's the way that we can all agree that this is the proper way to, right, arrange a peer-to-peer system? But right now there's no guidance, and it's part of like letting the market figure it out, right? Mistakes will be made. Unfortunately, right, the people who dwell first into the unknown, they're probably gonna get hurt. But for the time being, I think for traditional finance, they just look at the things that are safe, right? They know, okay, now we have the rule book, now we can build this product out, and then they come. But that's usually a little bit too late, right? That's when the big brands are built. I don't see so many people interested in having their Bitcoin at Deutsche Bank. I just don't understand it, but I think for them it's still worthwhile. There's probably a generation older than me that thinks that's a good idea, which also means that we're now becoming more inclusive, bringing more people to cryptocurrency that before wouldn't even dabble with it because of the image of the upstart, the unregulated, and the new.
All right. So I see a huge movement is happening on converging TradFi and DeFi. Especially the stablecoin is really a big topic, and I want to touch upon a pretty important framework paper published by BIS, Bank for International Settlements, last December, named Prudential Treatment of Crypto Asset Exposures, and that gives the central banks a clear guideline to treat cryptocurrencies. In that paper, it says we can separately treat cryptocurrency like a group 1 and group 2. If it is group 1, stablecoin, real world assets, tokenized equity, tokenized bonds, doesn't really it shouldn't be a burden. I mean, it used to be a 1,250% risk weight, but if banks hold crypto assets like stable coins and tokenized real world assets, you don't need to preserve that much of risk capital. So this is a really and then this Basel III framework upgrade is happening 2025 January, and this guidance will have a massive impact. And as far as I see, Japan took a pretty quick response to that and actually changed the law. And it's becoming effective since this month. And well, this means traditional banks can issue stable coins. And what's happening right now is Japan, like Mitsubishi, Sumitomo, they create a consortium to issue stable coins or real world asset tokens and make it interoperable. It used to be only like a private chain, but it's actually they preserve the interoperability between public chain and the private chain. So this means they're going to bring a lot of money in the stablecoin space, and they can interoperable with the public blockchain. So in this way, we can see a lot of potentials here. So I think we are seeing the beginning of the conversion of TradFi and DeFi. And for example, like 2 years ago, a major bank digital asset team member was just 6 people. But now it's grown to nearly 100. What it means is basically they're investing a lot for the digital assets business. So this, they're keeping calm, but I think I'm from traditional finance, so I see they want to get into this space, but they are just waiting for the regulatory clarity. But this clarity is now actually coming, and so I'm pretty bullish. In up to 2025, we see a strong new money inflow in this space. So I'll stop here.
Oh, I was going to give an answer.
I'll just ask one more question to the panel, and then we'll open it up for a few questions. So if you can think of some good questions for the panel, that'd be great. So Massa, I think it was the Basel framework update that you mentioned for banks. By the sounds of it, it seems like that could potentially bring in a lot of volume and load to blockchains. Are we kind of ready to support that kind of load? How do we scale DeFi to be able to meet the demands of these this big load that will come in?
Thank you. So in order to scale DeFi to massive TradFi grade, I think the regulatory compliance is really the key. But DeFi is basically the disintermediation, right? There's no central point of failure. There's no central point of control. That's a problem. So as a DeFi, I think the important thing is to embrace the regulatory concept and then bring it into the source code, which is called embedded supervision. That's actually also published in a BIS paper. So as a founder, and I'm also the programmer, so it's really important to understand how we can secure the market, how can mitigate the market manipulation, how to avoid the flashing attacks. And also nowadays, KYC, AML, those new tools are actually coming, a lot of things, like a zero knowledge KYC. And so we don't really need to rely on the central people to hold the users' information. So actually, zero knowledge KYC could be another potential to to level up the security. So those type of compliance is really important. And also, I personally think DeFi could be safer than TradFi because DeFi is everything is defined, every user activity is defined as a smart contract. So people cannot do outside of smart contract is defined. So we can actually pre-screen all these activities are legal or not. Because in TradFi, people can do whatever they want. But in the smart contract, we can only do the smart contracts thing. So we can actually do the smart contract legal audit and then make sure all these activities are legit. And also we can apply on a jurisdictional rules, so we can geofencing or token-gated access control. In that way, we can provide a granular control of the service provider. That type of activity is kind of is coming. So in this way, we can expand our volume to the TradFi level.
Are we ready to scale? No, I don't think so. I think we have to be realistic about that. This is a very nascent technology. It's been, DeFi was an umbrella term coined just a couple of years ago, and the earliest protocols are still finding their feet. Also, DeFi as an umbrella term is kind of a poor term for what exists on chain right now. There's a whole spectrum from immutable primitives right up to actively managed, more like CeFi type businesses that are running on chain, so the on chain finance rather than pure DeFi. So I do think, there needs to be massive upgrades, and of course, to support that, we need regulators that are forward-thinking and proactive in fostering innovation on chain, because there are huge benefits, efficiency benefits of composability and disintermediation that can be realized, but they can't really be realized in the current landscape and environment, I don't think so.
We have just sorry to cut you off. We have just a little bit of time now for a couple questions. So please raise your hand. Please raise your hand if you have a question. Do we have someone to pass the mic around? Yeah, go ahead.
So my question is, I talked a lot about DeFi and now's a very interesting time because blockchain is unpopular, unregulated, it was slump, and a lot of the fuzz has gone off. So it's quite a nice time to see what's going on and discuss it. You talk about DeFi, about efficiencies, like, fuck efficiencies. The problem isn't efficiency. The system we've got is efficient enough to fuck us all over, basically, right? What is DeFi really? That is, you talked about loans, right? If you're rich, you borrow money cheaply. If you're poor, you pay a lot to borrow money. That is a problem. It's a scam, right? The whole system is a scam where the economics are stacked towards the rich, right? What is DeFi really to change that? How are you going to structure a loan system in DeFi? Not be more efficient and faster, it's just basically perpetuate what we've got, but that allows using these technologies that we've got, that allows this technology to be more equitable and to allow people, so that poor people can buy a house or borrow money at the same rate as somebody who's got no money. Basically, if you're poor, you can't afford to borrow money because you're rich, and if you're rich, you get money from nothing.
Yeah, a very quick comment in that regard, and thank you for bringing up a real problem that I think is one that DeFi is really meant to solve. I think elegant DeFi protocol design tries to limit as much as possible the risk that's in the hands of the user for any given amount of time. So if you think about the Uniswap experience, users only bear risk or smart contract risk during the period in which they're doing their swap, and then afterwards, the risk is with the protocol. And so with Stargate, which was a DeFi protocol Layer 0 Labs built and launched, we also designed it so that LPs only bear the risk and users never do. Whereas I think a more archaic design within DeFi is a wrapped asset bridge, which locks value within the smart contract and then issues IOUs or synthetic assets. And with that, users are always bearing the risk of that smart contract. So I think there are savvy and elegant ways you can design protocols so that you restrict the amount of risk being put in the hands of users. I don't know if the two founders besides me want to speak a little bit to the use case this gentleman discussed, but thank you for asking it.
Yeah, I think the thing you bring up, right, this is like a founding principle of blockchain technology, and I think this is the interesting thing that we're watching, right? The closer it gets to traditional finance, the closer the integration, which is bimutual, right? Like there's people who are building blockchain technology that want to have access and want to create the access for the old financial world to use this technology to show that it's useful, right? To prove that it's actually something that the real world needs and not just some ivory tower coding. That at the same time starts to change the foundations and the core beliefs that the cypherpunk started with, right? And I think this is a question that everyone that works in the space needs to like literally look every day into the mirror and like ask himself, I'm a cypherpunk, I'm trying to build technology that is usable by everyone, no matter who they are, in the same way, right? Or am I starting to move towards working in traditional finance, right? And this is also why it's so interesting to have a panel of people about this topic, because clearly it's an internal conflict, right? To some extent in everyone, and not just a, yay, let's do it, right? There's a real question, should we, right? Should I? Should someone else? Am I missing out on opportunity by not doing it, right? Who's first, who's last?
I think that's all we have time for. Can I get a round of applause for our panel?